The beginning of 2022 looked hopeful for the global economy. The world was recovering from the pandemic, with businesses reopening and industries returning to the new normal until the Russia-Ukraine war broke out. The war disrupted the supply chain and the prices of essentials peaked. In addition, China's zero-COVID policy affected the global economy further. The previous economic crisis was followed by an easing monetary policy. This served as an antidote to the economic downturn, but it will not happen now. Advanced economies will not provide immediate easing policy. Governments are withdrawing COVID stimulus packages and are concentrating on controlling the high global inflation. This series of price hikes are causing an economic slowdown. The infrastructure, geopolitical tension between countries, and global uncertainties have moved investors' money to the U.S. As a result, the dollar reached record highs and other currencies are losing value. Slower growth is the symbol of the persisting economy. The U.S. is still fighting inflation, Europe is in recession because of high energy prices, and China is delaying its reopening. In addition, the U.S. Federal Reserve started a cycle of rate increases. This has fueled worries about a worldwide recession in major nations and rising inflation, which has reached a 41-year high in the UK. Economic reports think that the effects of several Federal Reserve rate rises are about to trigger a recession in 2023. Although 2023 shows some signs of economic growth, the recession is still a hanging sword on the working class heads. Tech giants like Amazon and Twitter are firing thousands of employees and leading CEOs expressing concern over the future. These are bold signs of a dark time for the working class, but don't forget that riches are made in the recession. The recession is the perfect time to build wealth. If you don't believe us, hear it from Warren Buffett himself. He said that the bad news is an investor's best friend. Where to invest during a recession? Investing in assets that are not linked to the market. There are investment options that could be more affected by economic downturns. The investment instruments less impacted by economic downturns are stable asset classes. The stable asset classes are gold, bonds, and fixed or debt instruments. Some of these investments could be more attractive in terms of returns. In addition, there are new age alternatives that provide good returns, such as peer-to-peer lending or fixed income instruments. They promise you good returns while not being linked to the market. These are some of the lucrative investment options. All the investment options are subjected to some degree of volatility and risk. Market-linked assets are the first ones that get affected during any type of economic downturn. So investing in assets that are not directly linked to the market is safe. Among all other options, real estate is considered stable as it is not directly linked to the market. It is a known fact that commercial real estate is one of the most stable and promising assets. The demand and performance of the real estate market have been constant over the years, if not increasing. Invest in dividend stocks. The dividend is a reward that publicly listed companies extend to their shareholders. Its source is the company's net profit. These rewards can be either in the form of cash, shares, etc. The company's board of directors decides the rate of the dividend. Sometimes the approval of a majority of the shareholders is also considered. The company may also decide to retain its accumulated profits to reinvest in the business or for future use. Announcing dividend stocks shows a significant increase in the company's stock values. Companies that provide consistent dividends are considered reliable with strong profits. Therefore, their stocks are less volatile. However, this doesn't guarantee steady stock returns. Dividend yield funds can be a good choice to invest in the recession. Do you want your portfolio to be less volatile? Then make sure to invest in dividend stocks. This doesn't mean that high-quality dividend stocks don't fluctuate. They fluctuate, but comparatively less than other kinds of stocks. This means your portfolio will not bounce around much. There is a possibility that companies can offer cash dividends. This will be a great help to you during the recession. If you don't feel that you are experienced enough to pick your dividend stock, you can buy a stock fund and enjoy the reduced risk that comes with the diversification of your portfolio, and still enjoy the great dividend yield. In addition, you'll enjoy a higher total yield if you buy while stock prices are lower. High-yield savings account. It is a traditional belief that cash is a good investment, and it is true. Cash can be a great investment because many recessions don't last as long as you think they would. In addition, cash gives you a lot of options. During a recession, having cash gives you the privilege. You can spend it if you lose your job, invest in the stock market if the market suddenly sells off, or you can invest in the house of your dreams. However, there is a downside to holding too much cash during a recession. Inflation can eat all your savings, and you may not have enough interest to cover it. So keep your money in a high-yield savings account for future purposes and use it strategically. Roth Individual Retirement Account. This is the perfect time to have the tax-advantaged Roth individual retirement account if you already don't have one. Roth's individual retirement account is different from the traditional individual retirement account. With traditional IRAs, you delay paying any taxes until you withdraw funds from your account later in retirement. But with a Roth IRA, you pay taxes up front by contributing after-tax dollars, and when you retire, your withdrawals are tax-free as long as your account has been open for at least 5 years. Traditional individual retirement funds are most effective if you expect to be in a lower tax bracket when you retire. Roth individual retirement funds are best if you are in a lower tax bracket today. In addition, Roth individual funds are best for younger investors who are early on in their careers and are planning to have more income and a higher tax rate when they retire. While investing, prepare yourself to face a recession. On a side note, you must prepare yourself to face a recession. Make sure you have an emergency fund to reach out to. Try to cut back on wanted expenses and invest them in a high-return savings account. Think ahead and invest in assets with better returns. Invest in assets with low or medium risk. Try to pay off your debts before the economy hits pit bottom. Have a stable source of income. Maintain a diverse portfolio, but make sure you invest in low-risk and not market-linked assets along with high-risk and high-return assets. The key is to calculate how much risk you can afford to take. Have a part of your easily liquid savings. Consider investing your money in avenues that offer inflation-beating returns to avoid negative returns in the long term. During the recession, it is important to consider your long-term goals. Avoid making decisions in a hurry. These could prove costly and will cost your investments. Diversification is the best way to ensure a healthy and stable investment portfolio in the long run, even if investing in some short-term, high-yielding options is tempting. Also, what are the best and worst sectors to invest in during the recession? In 2021, a study titled "Is Healthcare Employment Resilient and Recession-Proof?" found that hiring remained stable in the healthcare sector during the recession. This shows that the healthcare sector is indeed recession-proof. The healthcare sector includes biotech and pharmaceutical companies. The consumer staples sector includes food and beverages, household and personal products. It even includes alcohol and tobacco. Investing in quality assets is important to protect the portfolio during the recession. Economic experts consider some sectors as evergreen. They are education, healthcare, finances, and many others. Few sectors run no matter what happens. Identify such industries and invest in them. These are low-risk industries because they always have a business. These are more stable compared to other industries. There is nothing like zero or no risk. Every asset has its pros and cons. Avoid investing in highly leveraged companies during a recession. These companies pose a high risk because they are most likely to run out of business. It is important to analyze your situation and make financial decisions based on how much risk you can afford. So what do you think about making these investments during a recession? Let us know your views about these investment strategies in the comments below and stay tuned for more.